As we enter week 6 of class, we are going to spend some time talking about pensions and post-retirement benefits. So I'm going to first lecture on some of the concepts and the methodology behind accounting for pensions and post-retirement benefits. And then in a separate video, I am going to go through a lengthy example of how a pension might work and the journal entries associated with that. So today we are going to talk about 5 different topics. We're going to talk about the difference between a defined contribution plan and a defined benefit plan. We're going to spend a lot of time talking about the components of pension expense, and then we'll end the lecture with a disclosure or a discussion over the disclosure requirements, as well as post-retirement benefits, which are slightly different than the typical defined contribution plan or defined benefit plan. So first, let's take a few minutes and talk about really what pension plans in general are. So a pension plan is an arrangement where an employer is going to provide benefits, typically in the form of cash payments, to retired employees, and they're going to pay those benefits because of the services or the years of work that those employees provided. There are 2 components to a pension plan. There is accounting for the employer, so the company itself, how they actually need to record these pension amounts in their financial statements. And then there's also accounting for the pension fund itself. And that is not covered in this course. We're only focusing on accounting for the employer. In order for a pension plan to work, the employer has to make contributions to the pension fund. Those contributions are in cash. And then the pension fund, which is typically run by a third party, is responsible for receiving those contributions, administering the pension assets, so that cash that the employer is paying in is going to be invested in stocks, bonds, etc. Those become the pension assets. And then ultimately, those pension assets are what is going to be used to make benefit payments to the retired employees. A contributory pension plan is a pension plan in which employees may also contribute, aka make payments, to increase their benefits or to bear a portion of the cost of the stated benefits, depending on what is outlined in the pension plan documents. And then finally, if you have a qualified pension plan, what that allows for is that the employer can deduct the contributions that they're making for tax purposes, and those earnings can grow tax-free. So pension plans are kind of the overarching name, and then within that pension plan umbrella, there are 2 major types of plans. The first is a defined contribution plan, and in a defined contribution plan, the employer agrees to contribute to the pension trust or the pension assets a certain sum each period, and that period could be monthly, quarterly, annually, again, however it's stated in the pension plan document, based upon some formula that they've come up with. The formula can consider things such as age, lengths of service, employee salary. And so what I mean by that is how much they contribute might go up for the longer the employees work there or the higher the employee's salary. Because of the name, where it's called defined contribution plan, and this is the key differentiating factor from other types of plans, the plan defines only the employer's contribution and therefore makes no promise to the ultimate benefits that are going to be paid out upon retirement. So what that means is if the company contributes $100 million, right, but the stock market tanks and that $100 million becomes only worth $1 million, then that $1 million is what's going to be distributed out to all of the employees that are eligible to benefit from it. On the flip side, if a $100 million contribution, right, and the market's booming, turns into $1 billion, right, then the employees are going to receive more. So the most common example of a defined contribution plan is a 401k plan. Now, if you think about a 401k plan, perhaps you might have one. Typically what happens is you can elect to put in contributions to your 401k plan by taking out a certain amount of your paycheck every month or every week or bi-weekly, depending on how often you get paid. That money is taken out pre-tax, meaning that you don't pay federal or state taxes on that amount. And then as long as you don't withdraw that money before a specific age, you then get to take out some of that money on a tax-free basis. Now, usually what also happens is that periodically, usually either quarterly or annually, your employer will also contribute a certain sum of money to that plan, and therefore you will get a portion of that in your own individual account. It gets its name 401k because it's actually the IRS tax code 401k that provides those tax advantage benefits. Now, ultimately, how much money you're going to be able to withdraw in the terms of a benefit payment is going to depend on A, how much you invested, how much the company also invested on your behalf, the appreciation of those underlying assets, and any treatment of forfeitures for early termination of other employees. So this really pertains to the contribution that the employer is making. So depending on the pension plan document, and I keep referencing pension plan document, that is the document that basically outlines how the contribution plan is going to work. So sometimes the company will make contributions, but then you are required to stay for another year or 3 years. And so what that means is that you haven't vested in those benefits yet. So if you were to leave the company, you would lose part of that company match. Now, some companies, on the other hand, say that you vest immediately. And so once they put that money into your account, it's yours. So if employees leave and kind of how the company determines whether your cash is vested or not vested will dictate whether or not you could potentially receive any more amounts from individuals who have left the company. Now, the other nice thing about defined contribution plans is that this accounting is very straightforward. And it's very straightforward because the yearly expense that the company incurs is equal to the amount that they contributed. And a liability is going to exist only if payment is not made fully by the end of the year. So basically, there's a two-line journal entry that is going to be recorded here, and it's basically going to be debit your 401k expense, and then either credit cash or credit a liability account. And when I say debit a 401k expense, that's not actually the name of the account, but it would be something like debit, employee benefit expense, because it's just another form of an employee-related expense, just like wages are, or just like vacation accruals are, etc. So when it comes to the reporting requirements for a defined contribution plan, there needs to be a short description of the plan, the annual pension expense or the annual amount of expense related to the particular defined contribution plan, what employees are covered by the plan, the basis for determining contributions. So on the previous slide, I talked about how it's based on a formula with years of service or age or salary. So kind of how the basis is determined. And then the nature and effect of significant matters affecting comparability from period to period, if there are any changes over time. So Most companies that I have seen just give their employees a percentage of the amount that the employees contributed over the year. So like 3% or 5%, etc. The other thing I want to just point out is when it says employee groups covered by the plan, so it is not uncommon for a company to have multiple contribution plans for different types of employees. So they may have different plans because of different requirements in certain states. So certain states might, there might be a certain plan set up just for the employees of a certain state. Oftentimes, companies may have different plans for their hourly associates versus their salaried associates. You see this a lot in the case where a company might be like in the manufacturing industry where they've got a lot of like warehouse or manufacturing workers that might be on an hourly basis versus like corporate level associates, which might be salaried. You also sometimes see this when companies acquire other companies. So, for example, Hormel has over the years acquired a number of smaller companies, and sometimes those smaller companies have their own contribution plans, and sometimes it's just easier to maintain them separately versus trying to merge them, especially if the terms of the plans are different. You can create a lot of ill will between employees if employees in one plan, if they merge into another, are going to lose certain benefits, or if the two plans aren't really in sync. So I think if you look at your SEC 10K companies, I would say probably at least 90-95% of them are going to have a type of defined contribution plan. The other option is something known as a defined benefit plan, often abbreviated as DBP. And under a defined benefit plan, as the name implies, employees are going to receive a specific benefit when they retire. Again, this is usually based on the employee's years of service as well as their salary. The longer you work for a company, the higher your salary, the larger your benefit. Employers must determine what contributions must be made today to accumulate the amount of future benefits. So this is, basically a very large time value of money problem. So this one is a little bit different because instead of saying a set amount of contributions, what they're saying is, I'm going to provide you a set amount of benefits. Now, when it comes to sort of managing this type of pension, the pension trust, basically the body that is administering this pension, is a separate entity. So, you're going to be, the employer is going to be sending money, kind of, writing a check to a separate sort of company that's sort of doing the administration. However, even though it's a separate entity, in the trust assets and the trust liabilities belong to the employer, and the employer is responsible for payments of those defined benefits regardless of whether or not there's enough money in those pension assets to pay for those benefits. And so what you'll see when it comes to defined benefit plans is within the financial statements, you're either going to see a net pension liability or a net pension asset, depending on whether or not this pension is overfunded or underfunded. And we'll talk a little bit more about that in a few minutes. Now, what makes defined benefit plans so challenging is because you are promising a specific benefit in the future, right? You have to account for a whole host of variables. For example, how long is your employee going to live for? What's their mortality rate? What is the turnover, right? How many years is your employee going to work for you? What's their future salary going to be? What are interest rates going to be? How well is that pension asset going to grow? going to accumulate in value over time. So there are so many variables that have to be taken into consideration, which is one of the reasons why pension plans, defined benefit plans, are so challenging to account for. So how most companies will do it is they'll use actuaries to help them determine some of these rates, to look at historical trends, to help project the future. And there are companies that are simply devoted to helping with these types of plans. Now, what's interesting is that a survey of Fortune 500 companies, so the largest 500 companies in the U.S., in 1998, 59% of them had a defined benefit plan. By 2017, so about 20 years later, that was down to 16%. And one of the reasons for the sharp decline is because defined benefit plans are really expensive, because you are promising a specific benefit in the future. One of the reasons that the U.S. Postal Service is in such dire straits financially is because they have a huge pension obligation to their employees. And I'm going to post an article that kind of just goes through some of that a little bit more if you're interested in reading about it. So, because the accounting for defined contribution plans is so easy, what we're really going to be focusing on is the accounting for defined benefit plans. And when it comes to those defined benefit plans, there are two major questions that we need to answer. The first is, what pension obligation, aka the liability, should the company report in its financial statements? And the second question is, what is the pension expense for the period? So when it comes to the pension obligation, this is basically the deferred compensation that we need to pay to employees for their service under the terms of the pension plan. So think of this kind of as, when you're an employee, right, and you earn vacation, right, every day of vacation that you earn gets a debit to vacation expense and a credit to the vacation liability. Now that's pretty straightforward because you're earning a specific salary right now, right? So if you earn 1 day, they take 1 day's worth of your salary, and that's how they accrue for it. Now, adds a little complication when it's, well, are you going to be taking that day of vacation when your salary is at the current rate, or whatever your current salary is? Or if you wait a year, right, maybe your salary increases from your annual performance review, or maybe you go and get a different job. So there's a little bit of estimation perhaps that needs to occur there. There's even more so when it comes to your defined benefit plans, because it's not that you're getting your benefit a year from now. You might be getting your benefit 20 years from now or 30 years from now, depending how far you are away from retirement. It's also important for the pension obligation to include both retired employees currently receiving benefits, as well as current employees that can expect payments in the future once they retire. So when it comes to kind of calculating that pension obligation, there are kind of 3 tiers of thought. The first is just look at vested benefit obligation only. And so this pension obligation is going to compute the future obligation using only employees who are vested in the plan, and assumes no additional years of service. So those future payments are calculated using the current salary level only. So this calculation is going to result in the absolute lowest pension obligation liability possible. The second option is to use accumulated benefits. So this one is going to use both vested and non-vested employees, but also stop at what their current salary is. So not projecting any future salary increases. This one is going to be a little bit larger than the vested benefit obligation, but not as large as the projected benefit obligation, or the PBO. So under the PBO method, you're going to use both vested and non-vested employees, so your whole population of employees, and it's going to project what they think their future salaries are going to be. The PBO is the method that is required for GAAP purposes. And then I already mentioned earlier, the second major question is what is the pension expense for the period? So what is our annual pension expense? So when you look at the financial statements for a company that has a defined benefit plan, you are not going to see a line for both pension plan assets and PBO or pension liability. Instead, what you're going to see is the net funded status. And what that means is that the employer has to recognize the full overfunded or underfunded status of the defined benefit plan. That's calculated as the difference between the fair value of the plan assets and the projected benefit obligation. So if we look at an example, Baker Company has a projected benefit obligation of $300,000, and the fair value of its plan assets is $210,000. Therefore, the company's pension plan is underfunded because we owe out $300,000, but we only have assets that can be converted into cash worth $210,000. So therefore, it's underfunded, and what you're going to see on the financial statements for Baker Company is a pension liability of $90,000. Now, on the flip side, if the fair market value of the plan assets was $430,000, in this case then, we say that the pension is overfunded by $130,000. And so what you're going to see is an asset of $130,000, like pension plan asset, on the face of your balance sheet. So now let's move on and talk about the various components of pension expense. So, like all other components of U.S. GAAP, it should be accounted for using the accrual basis. And what we're going to do is measure the cost and its identification with the appropriate time period. And this is going to become extremely important when we get into some of the components where we're amortizing things over a number of years. So there are about 7 or 8 different components to pension expense that we're going to take a look at. So what I'm going to do first is kind of just high level explain what they are, and then we'll go through several of them in a little bit more detail. So the first is service cost. And service cost is the expense caused by an increase in pension benefits payable, aka really the change in the projected benefit obligation over time. Specifically, though, related to the service the employees gave in the current year. So, I worked another year, therefore, because I worked another year, I'm owed more benefits. I'm owed more benefits because I have an extra year of service, and perhaps even because my salary is higher. So that's the first component, called service cost. The second component is interest on the liability, and this is the time value of money factor. So the pension liability is recorded on a discounted basis, right? We've discounted it back to present time, and therefore we have interest expense that accrues each year on the PBO. The calculation for interest on the liability is going to use an interest rate, which will be provided to you in the problems, and that's known as the settlement rate. So if you see the word settlement rate, you should associate that with interest on the liability. Now, for the purposes of our class, I'm going to give that rate to you, but in real world, this is one of the assumptions that the actuarial company that's helping you with your pension plan would help you determine. The next component is the actual return on plan assets. So, you invest the contributions, the cash contributions, into plan assets, and those plan assets then are going to be invested in various debt and equity securities. Those debt and equity securities are going to earn interest, dividends, And if they are equity securities, hopefully appreciation. And all three of those things then reduce the total pension expense. So it's important to remember that return on plan assets, okay, is not a additive component to pension expense, but it reduces pension expense. We also might have amortization of prior service cost. So I had mentioned before that you have a pension plan document, and that governs kind of how the pension is going to be run, how the ultimate benefits are going to be calculated, etc. It's possible that over time there are amendments to that plan that could either increase or decrease the benefits that employees are going to receive. Now, most of the time, those plan amendments are going to decrease the benefits because companies are looking for ways to reduce the burden of these pensions, but not always. And so what we have to do then when we have a prior service cost that's going to either increase, meaning pension expense is going to go up, or decrease, pension expense is going to go down, is that typically relates to services that have been provided in prior years. And so we need to allocate this prior service cost or benefit, if it's a reduction, to the remaining service years of the infected employees, right? It would not be appropriate to take either a large charge, an increase in the pension expense, or a large benefit, a decrease, just in 1 year. So what we want to do is instead we want to smooth it out, we want to spread it out over the remaining service years. And then another component of pension expense is the difference between the actual return and the expected return on plan assets and the amortization of that net gain or loss. So this is similar to the previous example where we have an actual return on plan assets. We've talked about that a couple minutes ago. But for companies, what they do is they calculate an expected return, again, to kind of smooth out their pension expense over time. And then the difference between what was expected and what was actual gets recorded into OCI, and then we amortize that difference over time back into pension expense. We'll go through that in more detail in just a minute. Okay, so let's first focus then on the first component, which is service cost. So service cost is going to be the actuarial present value of the benefits attributed by the pension benefit formula to employee service during the period. So we have employees, they worked a year, that resulted in additional benefits that they are owed. We need to calculate that using a formula that the actuaries are going to come up with, and we need to make sure that that is discounted back to the present value. The interest on the liability is the interest expense component of the pension expense. So we know that this liability has been deferred until the employee retires and becomes eligible to receive benefits. Because it's deferred, it means that the liability has been recorded on a discounted basis, and therefore the liability is going to accrue interest over the life of the employee. The interest component of pension expense is based upon a simple formula, and that is taking the beginning balance of the PBO, so the balance on 1/1 of whatever year, multiplied by the settlement rate. Okay, so we use a simple compounding interest on an annual basis. And then the rate that should be used, and again I mentioned that the actuaries are going to help come up with this rate, but the rate utilized should reflect the rate at which the specific company can effectively settle pension benefits by looking for an investment currently available whose cash flows match the timing and amount of the expected benefit payments. So that was a mouthful, but if we just kind of break that apart, what it basically means is if I have to start making payments 5 years from now, and I'm making this a very easy example, but if I have to start making payments 5 years from now, and I'm going to need to make $1 million payment each year for the next 10 years, what investment could I invest in today that would give me those types of returns? So basically I'm looking for an investment that's going to give me an annuity with the first payout being 5 years from now and there being 10 payments. What is the interest rate on that investment? And whatever that interest rate is, that's what I should then use as my settlement rate. So again, for the problems in our class, you are not going to be expected to determine the interest rate. It will be given to you. The actual return on plan assets. So I mentioned that the plan assets are going to be invested in stocks, bonds, real estate, whatever other securities, with a rate of return and a risk profile that works for whatever is kind of been defined in the pension plan assets or the pension plan document. Most pension plan documents are going to outline kind of what the mix of different types of investments the administrator is allowed to invest in. I mentioned that the actual return is going to decrease the employer's net cost, so decrease the pension expense. And it's calculated by taking the increase in the pension fund from interest, dividends, and realized and unrealized changes in the fair value. So the equation is going to be your actual return is going to be equal to the difference between your ending balance of your plan assets and your beginning balance, minus any contributions that have been made by the employer or by the employees, and plus any benefits paid. So what this really means is that this is kind of the plug between all the other known factors. If the actual return is positive, meaning that you had dividends, you had interest, you had appreciation in your stock, that is going to be then, you're going to take that amount and subtract it from computing pension expense. But it's also possible that your stocks may be depreciated or declined in value over the year, in which case, if your actual return is negative, you have to actually add it then to computing pension expense. Amortization of prior service cost. So you'll see prior service cost is often abbreviated PSC. So should a company report an expense for these prior service costs at the time it initiates or amends a plan? And the FASB says no, it's not appropriate to take that entire charge or benefit in the year of the amendment. Instead, you need to amortize that over time. So companies should not recognize the retroactive benefits as pension expense in the year of the amendment. What you're going to do is initially record that prior service cost as an adjustment to OCI, so other comprehensive income. We know that that's in the equity section. And then what we're going to do is recognize that prior service cost as a component of pension expense over the remaining service lives of the employees who are expected to benefit. We're going to use the years of service method to determine annual amortization expense, and we're going to go through an example of that in just a minute. So what this means when we amortize is we put an adjustment into OCI, and then over time we're going to take a small portion of that out of OCI and record it actually as pension expense. So in our example here, we have Cool Cats Company. Their defined benefit plan covers 170 employees, and they amend their plan on 1/1/2015, granting $80,000 of prior service cost to its employees. So what this means is that they made some change to their plan, and as a result, they have $80,000 of additional service costs. So the first option would be a debit to pension expense in 2015 and a credit to pension liability. However, we know that not all of that $80,000 was incurred in the current year, because what this is basically is a catch-up of, had this amendment been in place all along, we would have had higher service costs all along. So instead what we're going to do is we are going to determine the amount of years of service that this $80,000 relates to, and then amortize it over an appropriate amount of time. So we know that we have 170 employees. So if we look at our top chart, we have 5 different groups of employees that are all expected to retire at different times. And then the number of employees in each bucket adds up to 170. Okay. So we are, if we go back and look at our example, we are at the beginning of 2015. So what that means then is that if you are retiring at the end of 2015, you are going to provide 1 more year of service. So the number then of service years related to Group A is only 40, because 40 times 1 year. So if you look in the second table, then you see Group A, there's 40, total of 40. Okay. There are 20 employees in Group B. And in Group B, those employees are going to retire at the end of 2016. So they are going to provide 2 additional years of service. So they're going to have 20 years of service in 2015, 20 years of service in 2016. They have total service years of 40, calculated as 20 times 2. For the employees in Group C, there's 40 of them. They're going to retire in 3 years. So 40 times 3 is 120. So again, that 120 represents service years. So each employee gets a service year for each year that they are going to continue to keep working. Group D, 50 employees, they're going to retire in 4 years. 50 times 4, 200. And then Group E, 20 employees, they are going to retire in 5 years. 20 times 5 is 100. So then what we're going to do is we're going to add up all of these service years. So you add 40 and 40 and 120 and 200 and 100, and you get 500. So there are 500 service years left. Then what we're going to do is we're going to take that $80,000, that's our total prior service cost, we're going to divide that by 500, and that's going to give us $160 per service year. So what that means is that in 2015, we have a total number of service years of 170. So we're going to take $160 per service year times 170, and that is going to represent the amount of amortization of prior service costs that we need to include in pension expense for 2015. For 2016, it's going to be calculated as 130 times 160, 2017, 110 times 160, 2018, 70 times 160, 2019, 20 times 160. So what you end up then is, here's your total service years, your cost per service year, your annual amortization. So over those 5 years, right, you should end up with that $80,000. Now, alternatively, you can also use a straight line method over the average remaining service life of the employees. So we knew that we had 500 service years and we have 170 employees. So what that means then is that on average, each of those employees is going to work 2.94 years. That's 500 divided by 170. If you take that $80,000 then and divide it by 2.94, you get $27,211 per year. So the second method would be to amortize $27,211 in years 1 and 2, and only $25,578 in year 3. Now, this is a less precise method, because what you'll notice is that really, in total, there's 5 more years of service. However, what you'll also see here is the majority of the amortization is going to happen in those first 3 years anyways, because there's very few employees left. The benefit to using the straight line method, though, is that it's just much easier math keeping because you don't need quite as much information. However, in your homework, you will be expected to do a problem using the years of service method. Okay, now moving on to the gain or loss. So, one of the things that we know happens with markets is that appreciation, depreciation, right, just the stock market in general can be very volatile. And so, as a result, pension expense can also be very volatile because we know that the actual return on plan assets is a reduction to pension expense. And so, as a result, one of the things the FASB allows for is a smoothing technique to reduce some of that volatility. So, the smoothing technique on unexpected gains or losses on plan assets. So, before we get into the actual methodology, what would happen if a pension plan assets have a 40% return in a year? So if a plan assets have that large of a return, that means that they're going to have a significant reduction to the current year pension expense, which would also significantly reduce the amount that's required to be funded in the current year. Now, what that might mean then is that, your company's financial statements might look a lot better because you had a much lower pension charge in the current year, but then in the next year, what happens if pension plan assets have a negative 40% return, right? Then your pension expense is going to look a lot higher in the following year. So what actuaries will do is they'll ignore, current fluctuations, in a year time span, and instead they'll look more at the longer term, and they will come up with expected rates of return to help determine the funding pattern. And so they're going to come up with a expected rate of return that is going to be different from what the actual rate of return is. And then what's going to happen is the difference between the expected return and the actual return is going to be the unexpected gain or loss, or asset gain or loss, and that also gets recorded to OCI, and then it will get amortized into pension expense over time as well. There's also something that can happen with unexpected gains or losses on the pension liability. So in our previous example, we went over the unexpected gains or losses on the plan assets, but we also can have unexpected gains and losses on the pension liability. So we know that the pension liability is built in with tons of different assumptions on mortality rate, retirement rate, turnover rate, disability, expected salary, etc. And any changes to these rates, so typically the actuaries will review these rates on an annual basis and recommend changes. So any changes, especially if it's a significant change to the rate, can significantly impact the PBO. And so if we have these large unexpected gains or losses from changes in the PBO, we also record those into OCI, which can be netted against any asset gains or losses if they work in opposite directions, or obviously they're additive if they work in the same. So then what we have to look at is whether or not we're going to amortize those unexpected gains and losses out of OCI and into the pension expense. So, asset and liability gains and losses are not amortized, are accumulated from year to year in accumulated other comprehensive income and reported on the balance sheet in the stockholders' equity section. So, if you're not going to be amortizing it, right, it's recorded in the equity section and it's going to show up on your balance sheet. Now, the question then is, well, when do we amortize? So, in order to amortize any gain or loss, we need to look at something called the corridor. So, asset gain and losses and the liability gain or losses can offset each other. So, if you have an asset gain and a liability loss, you can offset those two within the OCI section. But what happens if they happen to be going in the same direction and the other accumulated income continues to grow, right? So in order to limit the growth, the FASB invented something known as the corridor approach for amortizing the accumulated balance when it gets to be too large. So they define too large as the 10% of whatever is larger, the beginning balance of the PBO or the beginning balance of the fair value of the plan assets. Now, obviously the PBO is a liability, therefore shows up as a negative number, and the plan assets are a positive number, so you're always looking at the absolute value. So anything above 10% has to be amortized, and the amortization recorded is whatever that excess is divided by the average remaining service period of active employees. So let's take a look at an example. So Dusty's Dinosaurs projected benefit obligation and plan assets over a period of 6 years is shown below. So again, we're always using the beginning of the year balance. So we've got the PBO and we've got the fair value of the pension plan assets. So the first thing that we need to look at is which one on an absolute value basis is bigger. So in 2011, it's the PBO. In 2012, it's also the PBO. In 13, 14, and 15, it switches to the asset, and in 16, it shifts back to the PBO. So once we've identified which is the larger amount, we then want to take 10% of that. So 10% of $1 million is $100,000, 10% of $1.2 million is $120,000, 10% of $1.7 million is $170,000, etc. So then we call this the corridor approach, and that's because if we have gains, right, we need anything that's larger than 10%, or if we have losses, it's anything that's less than 10%. So if we go to the next slide, what you'll notice is the corridor then, the safe zone is anything that is between these two lines. If it is outside of those two lines, then it needs to be amortized. So, second to last topic then is the financial statement presentation and disclosure. So, as it pertains to the defined benefit obligations, the balance sheet needs to disclose whether or not the pension plan is overfunded or underfunded. And if there's a pension asset, we are going to report this as a long-term asset, and it's considered restricted, meaning it's set aside for a specific purpose, and therefore can't be used for short-term liquidity needs. Okay? Again, your plan assets are going to be administered by a third party, so you don't, while you own those assets, you can't use those to help any for any liquidity needs that you have, because it's specifically set aside for a separate purpose. If you end up in a net liability position, you are going to report a current portion only for the portion that's payable in the next 12 months, and only if that amount cannot be funded from existing plan assets. So in most cases, this is very, very unusual, so you're not probably going to see any current pension liability on your financial statements. And if more than one pension plan exists, you can aggregate together and report them together as long as both plans are either in an overfunded or an underfunded status. And the reason for this is that each pension plan is separate, meaning you can't borrow funds from one pension plan to cover the liabilities of another. Each one is its own separate entity. So if you are not sure whether or not your company has either defined benefit plans or defined contribution plans, there will most definitely be a footnote in the 10K that describes what type of benefits they provide to their employees, if any. And then the final topic that we're going to spend a few minutes talking about is accounting for post-retirement benefits. So post-retirement benefits are other types of benefits that employers provide their employees that are not cash payouts. So the best example that I can give you for other types of post-retirement benefits are usually related to medical. So it could be dentist, it could be just doctor, it could be pharmacy, and so healthcare benefits in general are usually the next most popular type of post-retirement benefit. So this chart here kind of outlines some of the differences between normal pensions and then healthcare benefits. So when it comes to funding, we know that pensions are funded, that companies are providing contributions on an ongoing basis. Typically, when it comes to other post-retirement benefits, specifically healthcare benefits, they are generally not funded, in advance at least. The benefit for a pension is well defined, it's a level dollar amount. For healthcare benefits, oftentimes they are not defined. And what usually this means is it's uncapped, meaning you can use it as much as you want, depending on what your needs may be. When it comes to pensions, depending on what is outlined in the plan document, you may be able to assign a beneficiary. You may not be able to. If you are, oftentimes it has to be to a spouse. For example, I used to have a pension when I worked at Ernst & Young, and so again, the company was paying into this pension over time. I vested in this pension. I worked there enough years that I vested there, and then I left the company. And so as the results or as outlined in the pension plan document, if you were unmarried and you died, you received no benefits at all. So at the time I was not married, and I was a little concerned that I might lose out on some of those benefits. So what actually the company allowed for is a buyout, meaning they would pay me a lump sum of money to basically exit the pension plan now. And the reason companies sometimes do this is, what they're able to do is offer you less money now than they would ultimately have to pay you in the future. Now, because of my marital status at the time, right, it was like, well, I could take a chance, right, and expect that my status may change in the future, or I could just take the money now and contribute it to something else. And so what I did was I took that lump sum payout, and I was able to put that money, tax-free, into a 401k plan instead, and now, my money is growing, and there's no risk that I might, lose out on those benefits in the future. Healthcare benefits oftentimes will apply to the retiree, their spouse, and dependents if they're under a certain age. The benefit payment that ultimately gets paid out, for pensions, it's going to be a monthly payment. For healthcare benefits or other post-retirement benefits, it's on an as-needed basis, right? It's if you incur costs that can be reimbursed under that post-retirement benefit, then they will pay you out. Predictability, variables are reasonably predictable when it comes to pension expense. Again, we use a lot of actuaries. It's really hard, though, to predict how much money your retirees are going to need in terms of future medical care, because, when and if you're going to get sick is very difficult to predict. How much it's going to cost is difficult to predict because of differences in geography. And so That's one of the reasons why they're not funded, is because it's just so hard to determine how much money needs to be set aside. Now, I would say that post-retirement benefit plans are even probably more rare than the defined benefit plans, but you do see some of them with companies, especially companies that are significantly older or have been around for a long time, because this used to be very common for companies to have. And then if you do have post-retirement benefits, it's a form of deferred compensation. It's earned through employee service and subject to accrual during the years the employee is working. So what this means is that they do need to be recording a expense every year, and they are going to have a liability on their books. But what they aren't going to have is an offsetting account that is where they have assets used to pay for that liability. Okay, I'm just going to let you kind of read through the rest of those items. There is not a problem on the homework assignment related to post-retirement benefits, because it's just not something that I see very often. So I want to make sure that you know that it exists, but I'm not going to test you on being able to do an actual example. And then very similar to defined benefit calculations, when it comes to post-retirement expense, it's going to have the same type of components, although keep in mind that because I said that they're often unfunded, there would not actually be a return on plan assets, because there's nothing invested to help pay for those future costs. So that is the end of kind of the lecture component of this week. I'll have a separate video posted that will walk through an actual example of a pension plan and how to come up with the pension expense and how to determine the funded status. And so look for that video underneath this one.